Welcome back to Boni's Life, the channel where we navigate the complexities of the financial world with clarity and precision. If you're feeling a sense of whiplash from the crypto markets this week, you are not alone. What started as a promising continuation of a bull run quickly devolved into a sea of red, a brutal reckoning that has left many traders and investors questioning what comes next. We witnessed a market-wide capitulation, with billions of dollars in leverage positions wiped out and fear gripping the hearts of even the most seasoned participants. This wasn't just a dip, it was a structural test of the market's resilience, and the aftershocks are still being felt. In today's episode, we are going to dissect this tumultuous week with the intellectual rigor and in-depth analysis you've come to expect. We will leave no stone unturned. We'll conduct a day-by-day forensic review of the market's performance, identifying the precise moments the tide turned. We will delve deep into the fundamental and technical drivers behind this crash, separating the signal from the noise. We'll explore the global macroeconomic events that cast a long shadow over the digital asset space, from central bank policies to geopolitical tremors. Furthermore, we'll hold ourselves accountable by revisiting the projections we and other leading analysts made back in October, which forecasts held up under pressure and which crumbled in the face of reality. And, as always, we will quantify the impact. We'll analyze what a hypothetical $100 investment would look like after this week's bloodbath. Finally, we will chart a course forward, identifying key technical triggers, outlining potential trading scenarios with clear probabilities, and equipping you with the advanced insights needed to navigate the uncertain waters ahead. This is the analysis the institutions don't want you to have. So buckle up, because we are about to embark on a deep dive into one of the most pivotal weeks in recent crypto history. Let's begin our deep dive with a day-by-day breakdown of the past week's market carnage. It's crucial to understand the daily progression of this sell-off to appreciate the forces at play. Monday, November 3rd, the week began on a deceptively calm note. Bitcoin was trading around a respectable $106,521. Still within striking distance of its all-time high. However, beneath the surface, the first cracks were beginning to appear. Trading volume was relatively low, at around $35 billion, suggesting a lack of conviction from buyers. The market was in a state of cautious optimism, with many traders anticipating a fresh leg up. However, the failure to decisively break above the previous week's highs was a subtle but significant sign of weakness. The smart money was already beginning to take profits, sensing that the rally was losing steam. Tuesday, November 4th, this was the day the floor gave way. Bitcoin plummeted from its opening price of around $101,635, slicing through the psychologically significant $100,000 level with alarming ease. The sell-off was fast and brutal, fueled by a cascade of liquidations of over-leveraged long positions. The Fear and Greed Index, a key sentiment indicator, plunged into extreme fear territory, reaching its lowest level since April. The narrative of a new bull run was shattered, replaced by a palpable sense of panic. The mainstream media, which had been celebrating crypto's resurgence just weeks before, was now filled with headlines of a market crash. This was a classic example of how quickly sentiment can turn in the crypto space, and how a leverage-fueled rally can unravel in spectacular fashion. Wednesday, November 5th, the market attempted a feeble recovery on Wednesday, with Bitcoin clawing its way back to around $103,878. However, this was a dead cat bounce, a temporary reprieve in a larger downtrend. Trading volume surged to over $108 billion, the highest of the week, but this was driven by a mix of panic selling and opportunistic shorting, not genuine buying interest. The damage had been done, and the market was now in a state of shock. The narrative shifted from a quick recovery to a prolonged period of consolidation, with many analysts warning of further downside. Thursday, November 6th, the selling pressure resumed on Thursday, with Bitcoin dropping back to the $101,323 level. The market was now in a clear downtrend, with lower highs and lower lows. The initial shock had subsided, replaced by a grim sense of resignation. The focus shifted to identifying the key support levels that could halt the bleeding. The bulls were in full retreat, and the bears were firmly in control. This was a day of consolidation, but the underlying weakness was undeniable. Friday, November 7th, as we stand today, the market is attempting to find its footing. Bitcoin is trading in a tight range, with both bulls and bears hesitant to make a decisive move. The market is in a state of equilibrium, but it's a fragile one. The events of the past week have left a deep scar on the market's psyche, and it will take time for confidence to be restored. The question on everyone's mind is, what comes next? Are we on the verge of another leg down? Or is this the beginning of a bottoming process? In the next section, we will delve into the fundamental and technical factors that will likely determine the market's next move. Now that we have a clear picture of the week's events, let's peel back the layers and examine the fundamental forces that drove this market meltdown. It's never just one thing. It's a confluence of factors, a perfect storm of negative catalysts that, when combined, create a tidal wave of selling pressure. First and foremost, we have to talk about the crisis brewing in the corporate Bitcoin treasury space. For months, the narrative has been that corporations adding Bitcoin to their balance sheets would create a permanent source of buying pressure. However, this week we saw the first major crack in that narrative. Sequence Communications, a NYSE-listed company, was forced to sell nearly 1,000 Bitcoin at a loss to pay down its debt. This was a watershed moment. It demonstrated that these corporate treasuries are not the steadfast hodlers we were led to believe. When faced with financial pressure, they will sell, and that selling can have a significant impact on the market. This has created a sense of unease, with traders now questioning the stability of other highly leveraged Bitcoin treasury companies. The fear is that Sequence is just the tip of the iceberg, and that we could see a wave of forced selling from other companies in the weeks and months to come. Compounding this issue is the shifting macroeconomic landscape. The Federal Reserve has been in a rate-cutting cycle, which should theoretically be bullish for risk assets like crypto. However, the market's reaction has been counterintuitive. Despite the infusion of liquidity, we've seen a flight to safety, with investors flocking to traditional safe haven assets like gold, which has been hitting new all-time highs. This suggests that the market is more concerned about the underlying health of the economy than it is about the Fed's easy money policies. The hawkish commentary from some Fed officials has also added to the uncertainty, creating a sense of confusion and apprehension among investors. The market is caught in a tug-of-war between the Fed's dovish actions and its hawkish rhetoric, and that uncertainty is weighing heavily on risk assets. We also cannot ignore the contagion from the broader tech sector. The AI bubble, which has been a major driver of the stock market rally this year, is starting to show signs of bursting. We've seen a significant sell-off in many high-flying AI stocks, and that has created a risk-off sentiment that has spilled over into the crypto market. When investors get nervous, they sell their riskiest assets first, and for many that means crypto. The correlation between the Nasdaq and Bitcoin has been on the rise, and this week's tech sell-off was a major contributor to the crypto crash. Finally, we have the geopolitical dimension. President Trump's recent warnings about China's role in the crypto space have added another layer of uncertainty to the market. While the details are still scarce, the threat of a regulatory crackdown from either the US or China is enough to spook investors. We also have Elon Musk's dire warnings about a potential $38 trillion US debt crisis, which, while seemingly hyperbolic, has added to the overall sense of doom and gloom. These geopolitical and macroeconomic headwinds are creating a challenging environment for crypto, and it's unlikely that we'll see a sustained rally until some of these issues are resolved. Let's now shift our focus to the technical side of the equation. While fundamental factors provide the underlying narrative, it's the technical indicators that often provide the clearest signals for traders. And this week, the technical picture was overwhelmingly bearish. Bitcoin formed what technical analysts call a bearish engulfing candle on the daily time frame when the price collapsed on Tuesday. This pattern, where a large red candle completely engulfs the previous day's green candle, is a powerful reversal signal that often marks the beginning of a significant downtrend. For technical traders, this was a clear signal to exit long positions or even initiate shorts. Looking at the moving averages, the picture was equally grim. The 50-day moving average, which had acted as a dynamic support level throughout the recent rally, was decisively breached. This is a classic sign that the intermediate-term trend has turned bearish. The price is now trading well below both the 20-day and 50-day moving averages, which are now acting as resistance. Until Bitcoin can reclaim these key levels, the path of least resistance is to the downside. The next major support level to watch is the 200-day moving average, which currently sits around the $88,000 mark. A break below that level would signal a much deeper and more prolonged bear market. The derivatives market provides further confirmation of the bearish sentiment. We saw a massive $1.7 billion in liquidations this week, with the overwhelming majority being long positions. This indicates that the market was excessively leveraged to the long side, and the sell-off was exacerbated by a cascade of forced liquidations. The open interest, which represents the total number of outstanding futures contracts, has also declined significantly, suggesting that traders are closing out their positions and moving to the sidelines. The funding rates on perpetual swaps, which had been consistently positive during the rally, have now turned negative. This means that short sellers are now paying long holders, a clear sign that the sentiment has shifted from bullish to bearish. For Ethereum, the technical picture is even more precarious. ETH has underperformed Bitcoin significantly during this downturn, a common occurrence in crypto bear markets. It has broken below a key support level at $3,500 and is now struggling to hold above the $3,300 mark. The next major support for Ethereum is around the $3,000 level. The ETH/BTC ratio, which is a key indicator of altcoin market strength, has also broken down, suggesting that capital is flowing from altcoins back into the relative safety of Bitcoin. This is a classic risk-off signal for the broader crypto market. Until we see a sustained recovery in the ETH/BTC ratio, it's unlikely that we'll see a broad-based altcoin rally. Now, let's turn to a crucial part of our analysis: accountability. In the fast-paced world of crypto, it's easy to get caught up in the hype and forget about past predictions. But here at Boni's Life, we believe in holding ourselves and the so-called experts accountable. So, let's revisit the projections that were being made back in October and see how they stack up against the harsh reality of the past week. Back in October, the sentiment was overwhelmingly bullish. We saw a slew of analysts and firms calling for a significant rally into the end of the year. Galaxy Digital, for instance, had an initial price target of $185,000 for Bitcoin by the end of 2025. To their credit, they did revise this target down to $120,000 on November 5th, citing the market's entry into a new maturity era. However, even their revised target is looking increasingly optimistic in light of the recent price action. Tiger Research was even more bullish, with a target price of $200,000 for the fourth quarter. On the more conservative side, we had predictions from platforms like Binance and Changelly, which were forecasting a price in the range of $101,000 to $119,000. And then we had the ultra bulls like Chamath Palihapitiya, who was calling for a staggering $500,000 Bitcoin by October 2025. So, who got it right? Well, it's clear that the more conservative predictions were the most accurate. The forecasts from Binance and Changelly, which were in the low 100,000s, have proven to be remarkably prescient. They seemed to have a more realistic understanding of the market's dynamics and the potential for a correction. The more outlandish predictions, on the other hand, have been completely invalidated. The idea of a $500,000 Bitcoin by October now seems like a distant fantasy. This is a valuable lesson for all of us. It's easy to get swept up in the euphoria of a bull market, but it's crucial to maintain a sense of perspective and to be wary of predictions that seem too good to be true. The key takeaway here is that the market is a complex and unpredictable beast. No one has a crystal ball. But by analyzing a wide range of predictions and understanding the reasoning behind them, we can get a better sense of the market's potential trajectory. And more importantly, we can learn to identify the predictions that are grounded in sound analysis and those that are nothing more than wishful thinking. Now, let's bring this analysis down to a more personal level. It's one thing to talk about billions of dollars in liquidations and market cap fluctuations, but what does this mean for the individual investor? To answer that question, we're going to run a little experiment. Let's say that at the beginning of the week, on November 1st, you invested a hypothetical $100 into the market. How would that investment have fared after this week's brutal sell-off? Let's first consider a $100 investment solely in Bitcoin. On November 1st, the price of Bitcoin was approximately $110,014. By November 6th, that price had dropped to $101,323. That represents a decline of about 7.9%. So your initial $100 investment in Bitcoin would now be worth approximately $92.10, a loss of $7.90. While any loss is painful, this is a relatively modest decline given the scale of the market-wide panic we witnessed. Now, let's look at Ethereum. On November 1st, the price of ETH was around $3,872.21. By November 6th, it had fallen to $3,308.92, a much steeper decline of 14.55%. So your $100 investment in Ethereum would now be worth only $85.45, a loss of $14.55. This stark difference in performance between Bitcoin and Ethereum highlights a crucial concept in crypto investing: the flight to quality. During times of market stress, capital tends to flow from the more speculative altcoins into the relative safety of Bitcoin. This is why we often see Bitcoin's dominance increase during market downturns. It's the digital gold, the safe haven asset of the crypto world. Finally, let's consider a diversified portfolio with $50 invested in Bitcoin and $50 in Ethereum. In this scenario, your total portfolio value at the end of the week would be approximately $88.78, representing an overall loss of 11.22%. This demonstrates the benefits of diversification, as the more modest losses in Bitcoin help to offset the steeper decline in Ethereum. However, it also shows that in a market-wide sell-off, even a diversified portfolio is not immune to losses. The key lesson here is that risk management is paramount. The crypto market is notoriously volatile, and it's crucial to have a clear strategy for managing your risk. This includes setting stop losses, taking profits at regular intervals, and not over-leveraging your positions. The events of the past week were a harsh reminder that what goes up can, and often does, come down. And those who were not prepared for that eventuality were the ones who paid the heaviest price. So, where do we go from here? The market is at a critical juncture, and the next few days and weeks will be crucial in determining the direction of the trend for the remainder of the year. Let's explore some potential scenarios and identify the key technical triggers that you should be watching. Scenario 1. The bearish breakdown. 60% probability. This is, in my assessment, the most likely scenario. In this scenario, Bitcoin fails to hold the support around the $100,000 level and continues its descent. The first major target for the bears will be the 200-day moving average, which is currently around $88,000. A break below that level would be a major bearish signal and could open the door to a much deeper correction, with potential targets in the $70,000 to $80,000 range. The technical trigger for this scenario would be a daily close below the recent swing low of around $99,500. If we see that, it would be a clear signal that the bears are in full control and that further downside is likely. In this scenario, the optimal trading strategy would be to either remain in cash or to initiate short positions on any bounces. Attempting to catch a falling knife is a dangerous game, and it's better to wait for a clear sign of a bottom before re-entering the market. Scenario 2. The bullish reversal, 30% probability. This is the less likely but still possible scenario. In this scenario, Bitcoin manages to hold the $100,000 level and begins to grind its way back up. The first major resistance level to watch would be the 50-day moving average, which is currently around $108,000. A decisive break above that level would be a major bullish signal and could indicate that the correction is over. The technical trigger for this scenario would be a daily close above the recent swing high of around $104,000. If we see that, it would be a sign that the bulls are starting to regain control. In this scenario, the optimal trading strategy would be to start accumulating long positions on dips, with a tight stop loss below the $100,000 level. It's important to be patient and to wait for confirmation before getting too aggressive, as bear market rallies can be deceptive. Scenario 3. The sideways chop, 10% probability. This is the least likely but still possible scenario. In this scenario, Bitcoin gets stuck in a prolonged period of sideways consolidation, trading in a range between $100,000 and $105,000. This would be a period of low volatility and indecision, with neither the bulls nor the bears able to gain a clear advantage. This scenario would be frustrating for traders, as there would be limited opportunities for profitable trades. The best strategy in this scenario would be to remain on the sidelines and to wait for a clear breakout in either direction. The key technical triggers to watch are as follows. For the bearish scenario, a daily close below $99,500. For the bullish scenario, a daily close above $104,000. Additionally, keep a close eye on the volume. A breakout on high volume is much more reliable than a breakout on low volume. And finally, watch the derivatives market. A surge in open interest or a shift in funding rates can provide early warning signals of a major move. And that concludes our deep dive into this week's crypto market turmoil. We've dissected the events, analyzed the drivers, and explored the potential paths forward. The key takeaway is this. The market has undergone a significant structural shift. The era of easy gains and blind optimism is over. We are now in a more mature, more complex, and more challenging market environment. But with challenge comes opportunity. For those who are willing to do the work, to stay informed, and to approach the market with a clear and disciplined strategy, there are still immense opportunities for profit. Thank you for joining me on this journey. If you found this analysis valuable, please be sure to like, subscribe, and hit that notification bell so you don't miss our future episodes. And as always, I want to hear from you. What are your thoughts on the market? What are your predictions for the weeks and months to come? Let me know in the comments below. Until next time, stay sharp, stay informed, and trade smart.